Before we even talk about silver, we need to clear something up, because every week I see comments quoting things I never said, predictions I never made, and strategies that have nothing to do with this channel. And almost every time it traces back to the same place, copycat accounts using the same format, the same style, even the same thumbnails. But there's one thing they cannot copy, and that is accountability. Skin in the game cannot be cloned. One day they say silver is going to the moon, the next day they say it is going to zero. That is not analysis. That is hype farming. So before you listen to anyone pretending to use this format, verify the handle. OG John Edgy on X and YouTube. That is it. Everything else is noise. Here we look at both sides of the trade. Macro, micro, geopolitics, market structure, real data, even when it contradicts the bullish narrative people want to hear. And if you are getting value from that approach, drop OG in the comments and watch this video all the way through, because every section connects to the next. Skip one part and you miss the bigger picture. Now, yesterday I gave a very specific warning about silver, and it was not vague. I said if silver loses the 150 exponential moving average on the hourly chart near $90, the next major level to watch is $84.90 and potentially lower. That level was the line in the sand, and right now, as I'm recording this, Western spot silver is sitting around $79, with Western futures hovering near $81. The level did not hold. And if you are new here thinking this is hindsight analysis, that is fair skepticism. Markets are full of people claiming perfect predictions after the fact, but go look at the last video, go check the timestamps on my X account. The call was documented before the move happened. Not 10 scenarios, not 50 different possibilities to cover every outcome. One condition, lose the 150 EMA on the hourly close, and silver likely moves lower. Period. Now, obviously that call was not based on a single moving average by itself. No serious analysis works that way. There were multiple signals building behind that level. Liquidity conditions across global markets were tightening, the US dollar was strengthening, energy markets were entering a shock regime, and geopolitical risk was spilling directly into financial markets. That combination creates the exact environment where volatility spikes and technical levels break faster than expected. The moving average was simply the trigger point where all those forces intersected. Once it broke, the downside momentum accelerated, exactly the way stress markets tend to behave. But the real story here is not the moving average. The real story is what is happening across the entire global system at the same time. Because this morning, in just 80 minutes, roughly $1 trillion in market value disappeared from precious metals combined. Gold dropped around 2%, wiping out roughly $740 billion in market capitalization. Silver dropped between 10 and 11% in the same window, erasing about $260 billion. Think about that speed. 80 minutes, moves of that scale are not normal market reactions to a single headline. That is systemic pressure moving through multiple asset classes simultaneously. The US dollar is up roughly 1% on the day and now challenging levels not seen since mid-January. At the same time, the German DAX is down around 4%, Nasdaq futures are off more than 2%, and S&P futures are sliding as well. Meanwhile, natural gas is doing the opposite. European natural gas prices surged 20% today, on top of the 50% move we saw just yesterday. That is more than 70% in 2 days. Markets do not move like that unless they are pricing real energy disruption. And when energy disruption spreads through the global system, it hits everything from manufacturing expectations to inflation forecasts. That is the environment silver is trying to trade inside right now. And then there is Asia, South Korea. COSPI index was closed on Monday for a holiday, meaning it had no chance to react to the escalating military conflict involving Iran over the weekend. When the market reopened today, it immediately crashed more than 7%, erasing roughly $270 billion in market value in a single session. That was the largest one-day drop in Korea since the yen carry trade crisis in August 2024. In other words, it was not a gradual repricing, it was 2 days of geopolitical reality hitting the market all at once. This is the backdrop of silver's trading against. Expanding military conflict, energy supply shocks, currency volatility, and global equity stress all happening simultaneously. And that leads to the question many people are asking right now: if geopolitical risk is exploding and energy infrastructure is being attacked, why would silver fall 11% instead of rising? On the surface, it seems completely backwards, but the explanation lies in how algorithms and institutional models classify metals during crisis regimes. Silver is not purely a monetary metal. Roughly half of its demand comes from industrial applications: solar panels, electric vehicles, electronics, artificial intelligence hardware, defense systems, infrastructure components. When a market sees an energy shock and begins pricing the possibility of a global growth slowdown, those industrial demand projections immediately get reduced. Algorithms respond to that signal automatically. They do not ask whether the long-term silver supply deficit still exists. They react to the immediate growth scare. That is why in crisis regimes, the order almost always follows the same pattern. Gold first, because gold is purely monetary, then silver, because it is partially industrial, then platinum and copper, which are even more tied to economic production. The more industrial the metal, the harder it tends to get hit in the first wave of panic selling. That part of today's move is textbook macro behavior, but an 11% drop in less than 90 minutes clearly goes beyond macro positioning alone. And once you start looking deeper into where silver is actually trading around the world, the picture becomes far more complicated than the chart on your screen suggests. Now this is where things start getting interesting, because depending on which market you look at, silver is not trading at the same price at all. In the West, spot silver is sitting near $79 and futures are around 81, but in China, the numbers are completely different. Shanghai spot silver is still trading near 91 and Shanghai futures are around 92, even after the violent crash in Western markets. That premium between East and West is still roughly $12 per ounce. Think about what that means. Paper markets in New York pushed silver down more than 10% in under 90 minutes, yet physical pricing in Asia barely moved relative to that drop. When you see a divergence like that, it tells you the paper market and the physical market are not telling the same story. One is reacting to liquidity stress and algorithmic selling. The other is reacting to actual demand and physical supply conditions. And the difference between those two realities is where the real signal usually hides. To understand how disconnected the paper price has become from physical reality, look at the gold to silver ratio right now. In paper markets, the ratio sits around 62 to 1. That means it takes 62 ounces of silver to equal the value of 1 ounce of gold. But if you look at how metals are actually produced from the ground, the mining ratio is closer to 7 to 1. For roughly every ounce of gold mined globally, about 7 ounces of silver come out of the ground. The vault ratios tell a similar story. COMEX vaults show about 11 ounces of silver for every ounce of gold. The LBMA vaults in London show roughly 3 ounces of silver per ounce of gold, and when analysts estimate above-ground available supply that can realistically enter the market, the ratio approaches almost 1 to 1. Now compare those numbers to the paper trading ratio of 62 to 1. One of those numbers is eventually going to snap. So either silver collapses dramatically relative to gold, or silver reprices violently higher to close the gap between paper pricing and physical reality. Mathematics alone tells you the system cannot stay this disconnected forever. The real question is not whether the gap closes, but when it closes and what kind of event forces that adjustment. At the same time, another strange signal appeared in China. The Shanghai Gold Exchange released its weekly report covering February 24th through February 27th. Normally those reports include detailed inventory data for both gold and silver stored in the exchange vault system. But in this report, the silver inventory section was completely blank. Gold volumes were published exactly as usual, but every silver inventory line was zeroed out or missing. That is unusual. This exchange publishes those numbers every single week with consistent transparency. Yet during one of the most volatile weeks in precious metals markets and during escalating geopolitical conflict, the one data set that would reveal physical silver inventory suddenly disappears. That is not a random clerical mistake. Major financial exchanges do not accidentally erase inventory numbers. When data disappears during a crisis, it usually means the numbers themselves could create panic or expose structural stress. Ask yourself what those silver inventory levels might be showing if the exchange decided not to publish them at the exact moment prices were moving violently. At the same time, physical market indicators were moving in the opposite direction from the paper price collapse. Just days before the crash, silver touched $83, and during that run higher, something important was happening in the lending market. Lease rates for physical silver began rising steadily while the swap market turned increasingly negative. For people who do not track these signals closely, rising lease rates mean it is becoming more expensive to borrow physical silver. A negative swap indicates the futures curve is starting to reflect backwardation risk, meaning near-term physical metal is becoming more valuable than future delivery promises. Those are classic early warning signs of physical supply stress. In other words, the cost of obtaining real silver was rising at the exact same time the paper price was falling. That divergence between borrowing costs and market price does not happen often, and when it does, it usually indicates tension building underneath the surface of the market structure. The COMEX vault data supports that interpretation. On Friday alone, roughly 2.8 million ounces of silver were withdrawn from COMEX vaults. Those withdrawals came simultaneously from multiple vault operators, including Brinks, C&T, Delaware Depository, and JP Morgan. But the detail that matters is not just the withdrawal number itself. The key detail is that eligible silver, which represents metal stored in vaults but not currently registered for delivery against futures contracts, is declining faster than registered silver is increasing. That means the total amount of silver inside the COMEX system continues to fall even when registered inventory headlines appear stable. Some analysts like to focus only on the registered category because it is the metal officially available for future settlement, but when eligible inventories drain faster than registered inventories rise, the overall vault system is still shrinking. The bigger picture is a steady reduction in total physical silver available. Inside the exchange network, at the same time, another unusual event happened in Chinese derivatives markets. The Shanghai Futures Exchange announced that 5 additional groups of trading accounts were suspended for violating trading rules during the current volatility. Account suspensions during a period of extreme price movement are significant. Exchanges do not normally step in unless they believe certain participants are attempting to manipulate positioning or destabilize the market. When you combine that with the missing inventory data from the Shanghai Gold Exchange released the same week, it creates a pattern that is difficult to ignore. 2 separate Chinese exchanges taking unusual actions at the exact moment silver experiences historic price volatility globally. These events may not prove manipulation by themselves, but they certainly suggest that something unusual is happening behind the scenes in physical and derivatives markets. Simultaneously, and when those signals start appearing at the same time, physical inventories are draining and lease rates are rising, the silver market begins to look less like a normal commodity trade and more like a system under structural stress. Now we need to address the layer that most people hesitate to talk about openly, the structure of large institutional positioning and how volatility itself becomes a profit engine. Because once you understand that mechanism, sudden crashes inside tight time windows stop looking random. One of the most important players in the silver ecosystem right now is Jane Street, a massive quantitative trading firm that recently became the largest holder of shares in the BlackRock Silver Trust. In a single quarter, they accumulated roughly 20.6 million shares, representing about 3.6% of the entire trust. That is not a passive investment. Firms like Jane Street do not simply buy an asset and wait for the price to rise. Their entire business model revolves around volatility and derivatives. Over 87% of their $660, the $2 billion portfolio is structured through option strategies. That means the real profits do not come from the underlying asset itself, but from the price movement surrounding it. The structure is straightforward. First, build a large position in the underlying market, then layer a significantly larger derivatives position on top of it, and finally allow volatility to trigger the payoff. If price moves sharply in either direction, the options explode in value. Once the derivatives position pays out, the firm can reverse or hedge the underlying position and lock in profit. This strategy has been documented in several markets before. In India, regulators investigated Jane Street for manipulating cash market prices in order to profit from derivatives positions tied to those assets. In cryptocurrency markets, Terraform Labs accused the firm of participating in similar strategies during the collapse of the Terra ecosystem, a crisis that erased $40 billion from the digital asset market. Even Bitcoin traders noticed a pattern where heavy selling pressure appeared almost every day around 10 a.m. Eastern Time, creating a predictable drop that lasted for months before it suddenly stopped once legal scrutiny began. The pattern was so consistent that traders began calling it the 10 a.m. dump. When a trading behavior becomes so obvious that the entire market starts anticipating it, that tells you how powerful the structural incentives behind it must be. Now apply that same framework to silver. If a firm holds millions of shares in an ETF like SLV while simultaneously controlling a large options position tied to volatility in silver prices, a rapid 11% drop within 80 minutes becomes extremely profitable. And remember something else. The physical silver backing the SLV trust is stored by JP Morgan, a bank that has already paid nearly $1 billion in fines for manipulating precious metals markets in previous cases. That history does not automatically prove wrongdoing in this specific situation, but it certainly provides context. When the institution holding the metal and the institution holding the largest position in the ETF both have long records of market influence across multiple asset classes, a sudden violent move just before the New York Open starts to look less like coincidence and more like market structure doing exactly what it was designed to do. But there is another explanation that also deserves attention, because markets rarely move for only one reason. During genuine liquidity squeezes, the correlations across asset classes begin to collapse toward 1. That means everything sells at the same time, regardless of its underlying fundamentals. Stocks fall, bonds fall, metals fall, cryptocurrencies fall, and the US dollar rises because everyone is scrambling for cash to cover margin requirements. That is exactly what we saw today. Equity futures were falling across the board. The dollar was pushing toward highs not seen since January 15th, and investors were rapidly converting positions into cash to protect their portfolios. When the dollar strengthens sharply, it automatically creates downward pressure on commodities priced in dollars, including gold and silver. Even assets that have strong long-term fundamentals get liquidated temporarily because traders need liquidity immediately. In those moments, cash becomes the most valuable asset in the system. Margin calls accelerate, forced selling spreads across markets, and prices move much further than logic would normally allow. And this is where the geopolitical situation starts feeding directly into financial markets. The port of Fujairah in the United Arab Emirates, one of the only major oil shipping routes that allows tankers to bypass the Strait of Hormuz, was hit by a massive explosion. That port exists specifically to move oil around the choke point controlled by Iran. Targeting that route signals a deliberate strategy to disrupt alternative energy supply paths, not just the strait itself. At the same time, Iraq shut down the Rumaila oil field, the second largest oil field in the world, producing roughly 1.5 million barrels per day. That represents about 30% of Iraq's total oil output. When tankers cannot move through the Gulf region and production facilities begin shutting down, global oil storage systems start filling rapidly. Once storage reaches capacity, producers are forced to halt extraction entirely. That process is already beginning. Despite the broader market sell-off, oil prices still climb from 72 to 70%. $6 today, suggesting physical supply pressure is overpowering financial selling pressure, at least for now. Meanwhile, the United States has warned of imminent Iranian missile and drone attacks targeting Dhahran in Saudi Arabia, the headquarters of Saudi Aramco and the location of the largest proven oil reserves on the planet. Israeli officials have indicated that Saudi Arabia may be preparing to strike Iran directly, a move that would dramatically expand the conflict. China has publicly opposed American and Israeli military operations, signaling diplomatic support for Iran. The geopolitical lines are becoming clearer by the day, with the United States and Israel on one side and Iran increasingly backed by Chinese political pressure on the other. And then there was the statement from the US president that raised even more concern. Trump publicly declared that the conflict has barely begun and warned that the major escalation has not yet happened but will come soon. When you combine those signals with the fact that 15 different countries or military installations have already been struck, the largest Saudi refinery has gone offline, and Qatar's liquefied natural gas infrastructure has been disrupted, the scale of the potential energy shock becomes obvious. In an environment like that, financial markets do not behave rationally in the short term. Liquidity dominates everything. Assets that should logically rise sometimes fall because investors are scrambling to reduce risk and secure cash before the next shock hits the system. And that is exactly the environment silver is trying to navigate right now.